Hi, Gary here. You know, we just come off this great year for the stock market and really a really great cycle over the last 5 years. You know, from the low in March of 2009 to the recent high, the markets are up 170%. What does that mean? That means that if you had $1 million at the low in March of 2009 to today, you now have 2.7 million if you just made stock market rates of return. Well, sometimes the markets actually cause us to go into transitions relative to our investments. And that's what this is about. Now, there's two folks this normally applies to. It's those folks who are pre-retirees that are looking at, retiring in the next 0 to 5 years, and then those who are currently in retirement who have gone through these cycles in the last 10, 15 years and now have recovered back to where they need to be and want to make sure that they don't go through poorly the next bad cycle. I'm not saying the market's going down anytime soon. This is just making sure you're planning for the future. Now, if you've gone along and every year you're periodically updating and making sure that things are being adjusted to meet all those needs, you're in great shape. But if you haven't looked at your portfolio in a while and you're not certain as to where you are, recognize this. Recent statistics show that the number one concern by far for investors, successful investors, is wealth preservation, i.e. staying in the stay rich game, making sure you don't lose your assets. That's number one for all of us. So there's a couple things to consider here. There's really 3 major areas to look at when you look at your portfolios. One is, do you have buckets, let's say, set aside for cash flow needs over the next 3 to 5 years, at least for that long? Number 2, has your portfolio in the stock market got out of sync, i.e. it's not well diversified. You're too heavy in certain areas of the market and other areas. And number 3, do you have any investments that have heavy interest rate risk? We look at these markets getting better and the job picture getting better and the economy getting better, and it looks like the Fed may start raising interest rates. Well, that would really negatively affect anything that is very sensitive to interest rates. And those are kind of the 3 areas to look at. So the number one mistake that we see in portfolios is they're not goal-based. They're not goal-based on what you need for cash flow. And so the structure is bad so that the cash flow is not going to be there when there's a bad market. In other words, not to upset typically stock portfolios during these bad market cycles. That needs to be looked at first along with the other areas I just mentioned. So if you haven't reviewed your stuff in a while, go out and seek out financial counsel, a wealth manager to help you go through and take a look at everything. If you don't have anyone in that arena, you can certainly call us. We have a second opinion service where we'll look at your stuff and give you a second opinion as to where you are, where you need to go, and what's happening with everything in your particular estate, and help you make sure that you're really structured for the next downturn, whenever that is, someplace hopefully off in the future a long way from now. So until next time, enjoy.